So good morning to everyone today. We have a very, very special guest in our event for your investments, Mr. Kirtan Shah. Kirtan, welcome and thank you for making it to the live session. Let me introduce Kirtan to all our participants today. Kirtan is a serial entrepreneur and has a background of wealth management and financial education. He's currently building Credence Wealth Advisors, which manages about 5,000 crores of assets today. He has led brands like Ambition Learning Solutions, Financial Planning Academy, Pass4sure, and are hosted in his company SREdupro Pvt Limited. He is a frequent face on CNBC, TV18, CNBC Bazaar, ET Now Sandesh, Z Business, Bloomberg Quint, Live Mint, and Money Control. Kirtan has also co-authored 3 books on finance. Kirtan, very excited to speak to you today and learn about markets.
Nainesh, thank you so much for inviting me on this show of yours. Thanks so much.
So Kirtan, let me begin by asking you the biggest question everybody has on today's day. Okay, what is happening to markets right now? And the last week that we saw the massive fall, let me ask you, what on the macro level is triggering this, and how should an investor actually face these kind of falls?
So Nainesh, this is going to be a slightly longer answer, if you may allow, because I'll have to go back to the beginning of the COVID for a lot of our viewers to kind of understand what has gone wrong. तो अगर आप कोविड के स्टार्टिंग में जाएंगे, let's say go back to March 2020 types, right? तो आपने देखा कि अचानक से कोविड जब हिट किया, right? You would have seen that people started losing their jobs. Organizations could not keep up to the same kind of sales that they were doing in the past, and which is why a lot of pressure on them to lay off people. Economy was not going anywhere. GDP numbers बहुत बुरे दिख रहे थे. Inflation नीचे आ गया था क्योंकि products की demand नीचे आ गई थी. ये एक situation जो आप देखते हो in any crisis situation, right? Typically is a very common phenomenon. अगर आप 2000 का बबल देखे, 2008 का बबल देखे, 2013-14 में जो मार्केट्स में हुआ था वो देखे, या 2020 में जो हुआ, कभी भी क्राइसिस आती है, you will typically see companies not really performing well, their numbers going down, economy slowing down, job losses, and so on and so forth. तो अगर आप एक गवर्नमेंट है जो अपनी इकोनॉमी को स्टेबल रखना चाहते हैं, या जॉब्स रिवाइव करना चाहते हैं, या बिजनेसेस को बेनिफिट देना चाहते हैं, राइट? तो आपके पास बहुत सारे टूल्स नहीं हैं जो आप यूज कर सकते हो इकोनॉमी को वापस रिवाइव करने के लिए. तो 2 कॉमन टूल्स टिपिकली यूज किए जाते हैं जब भी ऐसी एक क्राइसिस सिचुएशन आती है. और आप अगर थोड़ा सा भी हिस्ट्री पढ़ेंगे, हर बार आप देखेंगे कि ये सेम चीजें की जाती है. तो वो क्या है? 2 चीजें. सबसे पहले तो इंटरेस्ट रेट्स को गिरा दिया जाता है, एंड सेकेंड यू डू समथिंग कॉल्ड एज क्वांटिटेटिव ईजिंग. अब अगर आप 2000 में चले जाओ तो क्वांटिटेटिव ईजिंग करके कोई कॉन्सेप्ट नहीं था. दिस कॉन्सेप्ट जस्ट केम द लास्ट 1 decade. बट टिपिकली ये दोनों चीजों का मतलब मोर और लेस सेम है. तो मान लीजिए एक ऐसी सिचुएशन जो फ्यूचर में भी आती है, जो मार्च 2020 में आई, where the economy slowed down, people started losing their jobs, companies were not doing very well, economy came to a standstill. So as a government, yeah, as a central bank, what will you really be able to do to revive the economy and bring it back on its feet? तो आप इंटरेस्ट रेट्स गिरा देते हो. क्यों आप इंटरेस्ट रेट्स गिराते हो? आप इंटरेस्ट रेट्स इसलिए गिराते हो क्योंकि शायद जब इंटरेस्ट रेट्स गिरते हैं तो आपका थॉट प्रोसेस ये है कि इंटरेस्ट रेट्स अगर कमजोर हो जाएंगे, इफ इंटरेस्ट रेट्स फॉल, देन इट विल बी एबल टू क्रिएट डिमांड इन द मार्केट. हाउ? लेट्स से एज एन इंडिविजुअल, if interest rates are low, there is more possibility that I would want to go ahead and borrow money from the bank, and borrowing that money from the bank, I would want to go ahead and make purchases. So I might buy a laptop, I might buy a phone, I might buy a car, bike, or even a house. तो जब interest rates कमजोर हो जाते हैं, you typically theoretically feel that the demand for loans will go up and hence demand for products, goods will go up. That's how you revive the economy, right? तो कभी भी economy जब नीचे जा रही है तो interest rates को नीचे कर दिए जाते हैं, क्योंकि interest rates नीचे करने पे ऐसा सोचा जाता है कि शायद demand वापस आ जाएगी क्योंकि लोन ज्यादा लेंगे लोग, right? कंपनी के कॉन्टेक्स्ट में भी यही है. As a large organization, if the interest rates are low, it is assumed that you will go ahead and borrow more money, do capex, right? And because you are going to do capex and all of that, job losses will come down, and probably you as a company will be able to do much better keeping future in mind, right? तो इसीलिए जब भी इकोनॉमी स्टैंड स्टिल हो जाती है, इंटरेस्ट रेट्स गिरा दिए जाते हैं, राइट? अभी ये क्वांटिटेटिव ईजिंग क्या है, right? Yeah, what is fueling of liquidity that a lot of our viewer friends today would have heard a lot of people like us, you and me, talk about over the last 2 years. तो होता क्या है ना, आरबीआई का काम है या किसी भी सेंट्रल बैंक का काम है पैसों की लिक्विडिटी मार्केट में मैनेज करना, राइट? तो जब भी उनको ऐसा लगता है कि मार्केट में बहुत पैसा है, वो मार्केट से पैसा खींचने की कोशिश करते हैं. And whenever they feel that the market does not have a lot of money, they find ways to infuse a lot of money in the market, right? Yeah. Now, how do they do that? Very simple. Now, without going into too much of technicality, right? What typically happens is RBI, right, on behalf of the government, issues bonds or fixed deposits. Consider it as simple as that, right? So RBI on behalf of the government comes to banks and people like you and me. They say, 1000 rupiya isme aap dalo, I will pay you 7%, right? So when you put 1000 rupees in that bond, right, RBI on behalf of the government gives you that bond या fixed deposit कि ये 5-7 साल में जब भी mature होगा पैसा वापस ले लेना. Now what happens is the more fixed deposits or bonds that I issue, I am taking money out from the market. Because the more bonds I issue, the more money you will invest. That's one way of sucking liquidity out of the system. पर crisis में क्या होता है ना, you want to do the reverse of this. So you go back to the banks, right? Tell the banks that, you know, I had taken money from you for the bonds that I gave you, but I want to buy that bonds back from you. So though the original maturity of the bond was 10 years, hypothetically, but today I need my bonds back. So what RBI does is, or Fed or any other central bank does is, they buy back those bonds from the bank, right? और सामने उनको cash दे देते हैं. Okay. Now, more and more cash is infused in the system to the banks by buying back these bonds. This is called quantitative easing or increasing liquidity in the market, right? अब RBI या Fed ऐसा क्यों कर रहा है? आरबीआई या फेड ये सोच रहा है कि अगर इतना सारा पैसा मैं अगर बॉन्ड्स बाय करके मार्केट्स को दे दूंगा तो वापस ये पैसा मार्केट में सर्कुलेट होगा, इंटरेस्ट रेट्स कम होंगे, ज्यादा पैसा है तो बैंक ज्यादा लेंड करेगा और डिमांड रिवाइव हो जाएगा. सो टिपिकली नैनेश, यू विल सी इन एनी क्राइसिस सिचुएशन व्हेन द इकोनॉमी नीड्स टू बी रिवाइव्ड, two things are done. Interest rates are got down and liquidity is fueled in the system, quantitative easing, by buying back the older bonds, right? ये same चीज हुई March 2020 में भी, या from there on, right? Where a lot of this liquidity was infused in the system, right? And interest rates were got down close to zero. अभी ये तो हुआ step 1 कि जब भी कोरोना क्राइसिस ने हिट किया तो सेंट्रल बैंक्स ने ग्लोबली कैसे रिएक्ट किया, इंटरेस्ट रेट्स को नीचे किया और मार्केट से बॉन्ड्स खरीदने लगे कि बैंक्स को और फाइनेंशियल इंस्टीट्यूशंस को पैसा मिले, राइट? अब इमेजिन कीजिए यू आर सिटिंग इन द यूएस, राइट? इंटरेस्ट रेट्स आर क्लोज टू जीरो, राइट? एंड एज एन इंडिविजुअल, क्योंकि आपके पास जॉब नहीं है, आपको अनएम्प्लॉयमेंट बेनिफिट के द्वारा $900 दिए जाते हर महीना, आप बाहर निकल नहीं रहे हो, खर्चा कहां करोगे? एज अ कॉर्पोरेट, इंटरेस्ट रेट क्लोज टू जीरो, आप जितना पैसा लेना चाहते हो ले लीजिए, ऑलमोस्ट फ्री पे मिल रहा है. और एज अ बैंक एंड फाइनेंशियल इंस्टीट्यूशंस, आपको सेंट्रल गवर्नमेंट, आपका फेड इतना ज्यादा पैसा दे रहा है बॉन्ड्स खरीद कर कि आपको पता नहीं इन पैसों का क्या करे. नाउ एवरीबडी, इंडिविजुअल्स, corporates, financial institutions, everybody is flooded with money. और आपका फिक्स्ड इनकम का रिटर्न या एफडीज का रिटर्न या डेट का रिटर्न, जो भी आप कहना चाहो, वो क्लोज टू जीरो है, तो पैसा कहां लगाएंगे? इज एग्जैक्टली व्हाई ऑल ऑफ दिस मनी फ्लू टू गोल्ड एंड इक्विटी. इसीलिए आपने 2020 और 2021 में देखा जो लिक्विडिटी ड्रिवन रैली, ये आपने टर्म बहुत सुना होगा, कि इतना ज्यादा लिक्विडिटी या पैसा था मार्केट में और फिक्स्ड इनकम के रेट्स क्लोज टू जीरो थे, अपॉर्चुनिटी नहीं थी कहीं और इन्वेस्ट करने के लिए एक्सेप्ट इक्विटी और गोल्ड. इसीलिए ये पैसा इक्विटी और गोल्ड में लगा और आपने इतना स्विफ्ट रिकवरी जो मार्केट में देखा 2020-21 में, वो इसकी वजह से था. Sorry for this long background, but coming to your answer.
No, thank you so much. Sorry, you explained it very, very well. In detail, and I think our viewers will be very happy to understand terms like quantitative easing. We've always heard it, but not many have understood it. So thanks, Kirtan, for that. So I'll take a question. Yeah. Sorry.
So I was just coming to your question of what's happening to the market over the last 4-5 days or probably a month. So look, now what has happened is we understood the background, right? कि ये liquidity driven rally था, इतना ज्यादा पैसा आया, ऑप्शन नहीं था आपके पास कहीं इन्वेस्ट करने के लिए, तो आपने गोल्ड और इक्विटी में पैसा लगा दिया. Now what is happening is, if you see over the last 2-3 months very specifically, right? आप देखिए businesses के results are almost as good as they were pre-COVID or probably better than that. राइट. आप देखिए ग्लोबली अनएम्प्लॉयमेंट रेट काफी कम हो गया है. पीपल आर नॉट नाउ आउट ऑफ जॉब्स एज दे वर प्री कोविड लेवल, राइट. और इसकी वजह से डिमांड भी बहुत वापस आ गई है और इन्फ्लेशन ऊपर जा रहा है, क्योंकि आप जितनी ज्यादा प्रोडक्ट्स खरीदोगे उसकी डिमांड करोगे, इन्फ्लेशन ऊपर जाएगी. तो अगर ये सब चीजें वापस आ गई है जो 2020 में चली गई थी, तो क्या आज हमें इंसेंटिव जीरो इंटरेस्ट रेट का या इतनी ज्यादा लिक्विडिटी की जरूरत है? द आंसर इज नो, प्रोबेबली. व्हिच इज व्हाई व्हाट द ग्लोबल सेंट्रल बैंक्स आर नाउ हिंटिंग टुवर्ड्स इज दैट वी आर गोइंग टू सक दिस लिक्विडिटी दैट वी गेव यू बैक आउट ऑफ द सिस्टम. वी आर गोइंग टू इंक्रीज इंटरेस्ट रेट्स एंड हेंस देयर इज दिस टेम्पररी blip on the downside in the market, right? Because the reason why markets went up were low interest rates, too much of liquidity in the market. So sentimentally, when you do the exact opposite, then now rates are going to go up and liquidity is going to go out of the system, right? You will typically sentimentally react on the negative side. Of course, there are a lot of technicalities around dollar movement impacting FIIs to move monies away, yield curves and stuff like that, but largely I think क्योंकि ये इंसेंटिव आपसे वापस ले लिया जा रहा है of interest rates increasing and excess liquidity sucking out of the system, ये एक temporary dip है मेरे हिसाब से market में reacting to this situation.
Sure. So I think that this actually answers the question कि इतना सारा liquidity एक साल में market में कैसे आया. So you explained it very well, saying this is the reason, where money had nowhere to go. So the only place they found is probably gold and equities. Now, again, to question you on something that you mentioned, okay? You told us that normally the pullout of this is a temporary measure, right? Markets normally give a knee-jerk reaction or a temporary fall aata hai. But let's talk about, a longer dated issue. So let's say in the year you had steroids, okay, you had the moment that you saw liquidity infusing, okay, on a coming basis, okay, if I see that liquidity is moving out, okay, if people are, let's say, my cost of capital starts increasing, what do you think? Okay, do you think markets will kind of react or move the way they have in the past, or do you think that once the shock is absorbed, markets then take their own course because you will have quality companies kind of moving because their cost of capital is managed, their money is managed, and then the economy moves from there on?
So Nainesh, again, I will like to give you this answer in 3-4 different points, right? All I can do is share some historical data points with you for us to be able to relate of what probably happened in the past. Can it repeat? Can it not? Right? Now, what is important for us to understand here? Look, today's situation, in my opinion, is very, very different from what it has gone through or happened over the last 10-20 years, where we saw something very similar. A couple of data points, just in Jan, if I'm not wrong, some 30 odd thousand or 28,000 odd crore worth of FII money has gone back, right? FIIs have been selling aggressively. Just in Jan, they've sold some $3-4 billion worth of equity already, right? Now, I'll tell you a challenge. In 2001 and 2008, where you had a similar crisis, had so much money been removed from the markets, you would have seen the markets go down by 30-40%.
Correct.
First is, our markets have largely become very resilient to foreign money, thanks to so much of this SIP and domestic institutional money that is getting pumped in by the retail investors.
Yes.
Right? So I think in terms of context, I think this is a very important data point that we really have to discuss, is because, largely historically our markets have been extremely dependent on how FIIs would react to a particular situation, and we were very nimble footed to how FIIs taking money out and markets dropping. I think that's a phenomenal move, in my opinion, thanks to retail participation, right? That this is getting more contextual in nature, in my opinion, right? Having said that, the kind of quantitative easing done this time around is extremely large, that we've not seen happen in the past, right? And hence the kind of money also that came in through the FIIs have been out of proportion. If I'm not wrong with this data, if you go back 18-20 months, you will realize that FIIs have pumped in some 2 lakh crore worth of investments in the Indian market. I don't remember the last time, if my memory serves me well, when did such kind of money really came in, right? So while I will now give you some historical data points, what I really wanted to lay down as a conversation is that today what we are seeing is very different. That has not happened historically. So historical data points may be a good data points to reflect on, but what can really happen may be slightly different of what happened historically, because the kind of liquidity and the FII movement, money coming in and going out, that we are talking about is way different of what happened in the past. Let me give you some data points, Nainesh. So if you look at US specifically, right, there have been 13 rate hike cycles that US has gone through since the 1950s. So we are talking about a 71-year data point where there have been 13 rate increase cycles. You will be surprised, while you see the markets react the way they are reacting right now, 12 out of those 13 interest rate hike cycles, right, equity markets have given positive returns.
Okay.
Right? So while you and I are discussing why, when interest rates are going up, inflation is going up, stuff like that, markets are reacting on the downside, history tells us in 13 Fed rate hike cycles, right, 12 out of those 13, US markets have gone up. There was only one rate hike between 1973 to 75, if I'm not wrong with the data point, is where the markets fell, because there was this crisis on the currency bit, if I'm not wrong, going around.
Yeah.
Right? Let me put this in context in the Indian terms, right? Out of these 13, because Indian markets have not been around since 1950, we've only seen 6 cycles of Fed rate hike. Out of those 6 cycles of Fed rate hike, 5 cycles we've been positive. We've only been negative in 1 cycle, which was 1993 to 1995. Now, why did I give you this data point? Is for me to convey to everybody viewing this that, look, what you're seeing in the market happen over the last 1 month, 2 months is a knee-jerk reaction, right? Because if you see between 2002 to 2006, where we've had probably the best rally that the Indian stock markets have ever seen happen, forgetting the last 2 years where things have been even more crazier. But if you look at contextually, 2002 to 2006-7 was probably the best rally that the Indian markets have ever seen. In that 4-year period or 5-year period, we saw the markets tank 20% 2 times, 30% 1 time. So in a period of 3-4 years, we've seen 20% once, 20% second time, 30% once. And yet we saw the biggest rally that happened in the Indian stock markets. And that was a period where interest rates were also going up. So what I'm trying to tell you is that yes, interest rates going up theoretically is negative for the markets, and you will see this large 20, 30 odd percent dips in a larger context over the next 3-5 years. But if at all our earnings have been able to keep pace with expectations, historical data points suggest that if earnings have been stable and if earnings have been able to keep pace with market expectations, markets over a 3 or 5 year period have always done well, even in a rate hike cycle. So the most important point which I really want to close this question of yours is, we cannot afford companies not meeting earning expectation, which is why you will see wherever earning expectations were not met or will not be met, markets will take those stocks down very seriously. But at any point in time, you see market expectations being met, even in a rising interest rate cycle, historical data points suggest that you might have these intermediary short knee-jerk reactions, but a 3 or 5 year period has always turned out well historically.
So I think interesting. All your data points are very, very interesting. And I think this will give our users an insight of how you should be looking at markets. Now let's talk about the next 3 years, right? Like you mentioned, this could be a knee jerk. Next 3 years, if earnings are met, the expectations are the way they are. If we meet them, we're actually heading to a quality return scenario. Now, obviously you've been an expert at this, so let me get to that. When I'm making a portfolio, when I'm building a portfolio, how important is equities as a part of a portfolio? That's my first question. And second, if we're considering equities for a layman, what should be his strategy or his way of the right manner of taking equity exposure?
So I think, Nainesh, look, very honestly, while we talk about fixed income, in general context also, every Indian has exposure to fixed income, right? Most of us do fixed deposits. A lot of us do PPF. A lot of us have employee provident fund in which our salaries get deducted and we have exposure to. So normal Indian retail investor typically may not consciously do it, but will always have exposure to fixed income, right? If we look at very simple data points in terms of fixed income, you and I both will realize that post-tax, fixed income has never been able to beat CPI inflation, right? So my expenses are increasing at probably 6% year on year, but the net post-tax that I make is typically in all cases less than 6%. So while I may be happy that 100 became 106 in fixed deposit at the end of the year, but what I was able to buy with that 100 rupees today, I'm not going to be able to buy the same product at even 106, right?
Yes.
Which is why I think fixed income is good to have in the portfolio. I use fixed income typically to take tactical bets. What I mean when I say tactical bets, I am extremely aggressive as an investor. I don't even want to tell you what kind of investments I do because this is more retail kind of a show, but I'm extremely aggressive, right? But I still have 20% exposure to fixed income. Why? Is because you will always realize, and it would have happened to you also and me also, right? That whenever market tanks 20% and you know that you want to buy the shares, you never have the money. You know? And you will see 9 out of 10 people hearing us today or maybe would hear the recording. They will relate to this कि जब शेयर खरीदना होता है तब पैसे ही नहीं होते. So I use fixed income allocation more for this reason, where I always want to keep this 20% aside that if tomorrow market tanks, I should have some money that I can tactically deploy back to equity, right? So for me, fixed income is more of a tactical bet. For a typical retail Indian, I think fixed income, unfortunately, does not. So you already have exposure to fixed income knowingly or unknowingly, right? And unfortunately, it does not beat inflation. So if you really want to keep pace with the changing inflationary situation in the market, expenses going up, I'm sure everybody hearing us will relate to how the kind of money that they spent when they were getting educated, and the kind of money that they are now spending for their child. The kind of money that I spent from my first standard to the 10th standard, I've spent 3 times the money for my nephew's 1 year of education in pre-primary. So the context, in my opinion, is to be able to beat inflation, right? And be able to grow wealth that 10 years later, when you have a goal, right? Do you have enough money to reach that goal? I think there is nothing better than equity. In my opinion, not even gold, but equity is the only asset class which will really be able to keep pace, outbeat inflation post-tax, so that you don't get a shock 10 years later while you want to reach out for a particular goal of yours, and you suddenly realize कि आज तो मुझे लगा था 5 लाख का खर्चा होएगा, पर 10 साल बाद when that actual cost is 30 lakhs, you are not really prepared for it. So equity investment, in my opinion, is a must have for every investor, because that's the only asset class, in my opinion, that'll really be able to beat inflation.
Yeah, so coming next, again, for a layman, okay, how do you go about investing in equities? What should be your strategy to invest in equities? Obviously, mutual funds, equity exposure is one way. Let's talk about how do you enter direct equities, and what would be your strategy as a layman to kind of have less risk but have some good exposure?
So, Nainesh, I think 2 steps that I would really suggest somebody who's a retail investor, or क्योंकि retail investors सुन रहे हैं, I don't want to talk too much of technical content and stuff here. 2 very simple things. First, and the first one is the most important thing that I really don't want anybody hearing me to ignore. ऐसा investment करे जो आपको समझता है, right? Why is this very important? Everybody now I see is jumping into chemicals, pharma, everybody wants to talk about how API and stuff is going to change the industry. I get so many of these guys asking me on Twitter and various other platforms. And I really understand while I talk to them that they don't know the industry at all. They don't know what the company does. Of course, you might get the fear of missing out because, pharma rallied so much, or chemicals rallied so much over the last 1 or 2 years for various things that happened globally, right? But my way of investing, or my suggestion to retail investors is, ऐसा investment करे जो आपको समझता है. Do not try and get carried away because some market expert is making comment on some sector, right? But if you don't understand the sector, you will never be able to keep up to being able to monitor what's happening in your stock. In my opinion, realistically, buying something and forgetting is not the way to invest, right? So first, invest only in sectors that you understand. Point 1. Point 2, because we also spoke of what are the basic parameters that probably a retail investor can look at before picking equity. Again, look, if you're a retail investor, try and make sure that you are not buying something which is less than a 7, 8, 10,000 crore worth of market cap, because you don't know how those stocks react. So you can use websites like the screeners.in and all of that, right? And even if you don't understand a lot of stock market, they have screeners that you can apply this rule that I'm telling you of, right? So apply this rule in my opinion. Okay, let's say stocks greater than 10,000 crore worth of market cap, right? Sales growing at 15%, profits growing at 15%, ROE and ROC growing at, let's say, 12 to 15%. Just put these 4 or 5 screeners, you will get a list of 30-40 stocks, right? Because you will not have more than that number of stocks falling in this category. उसमें से आप filter कर लीजिए कौन सी industries आपको समझ रही है. You will have those 10-12 stocks that you really want to invest in. That is what I would suggest retail investors do. Also, if you don't want to get into any of these things, right? Simple एक ETF खरीद लीजिए index का, right? और आपका काम हो जाएगा. So I think largely this is what, in my opinion, I would really suggest retail to.
So thanks. That was a very very simple explanation of how someone can really build wealth over a long term. Also filter your stocks with very very simple parameters and understand how long term horizons play a role. Right, like what we saw in the last year. Probably people expecting 100% returns over a 1 year period is all a myth. I mean, being in the market for so long, I'm sure you will agree with the same, that you do not randomly get 100% returns every single year. This is a one black swan, and I think we're not going to see this on and on. The
I
other
just
thing,
met a,
yeah,
I just met
sure,
a client yesterday that I was talking to you of. He said,
yeah.
I want zero risk on my portfolio and my portfolio should become 100% more the next year. I said, sorry, I can't help you.
I agree. I mean, the millennials today in the market expect 100% return. And honestly, because of that, we're seeing they don't understand risk in the market. I mean, if you actually entered the market somewhere in the late 2020s or the 2021, you barely seen blips. And that is the reason that the last week that went through, people would have got a shock saying, okay, index does come down, and that also consecutive days. So nice to know that. Also, one more thing you mentioned is the ETF. Okay, very very interesting concept, an index ETF. Okay, so here you would actually go out and get exposure to, let's say, 30 or 50 stocks respectively with a small investment amount. Do you think passive investments or ETF investments, for a retail client would actually be a way out if you come into SIPs on those ETFs? Just let me tell you, the Fisdom app, we have an opportunity for investors to come and place SIP orders, where it could be an ETF or it could be a favorite stock of yours. Like you said, you could probably screen down stocks and place SIP orders, and the system will itself buy the stock on a recurring time frame. So what do you think? Do you think that kind of strategy would really help someone build wealth, or do you think it is a little slow? You would not see wealth accumulation on an ongoing basis?
So, Nainesh, let me answer this question this way. Look, we have broadly, I'm not going into too much of technicality, but broadly, you will have large cap, mid cap, and small cap, right? Now, in my opinion, mid cap and small cap, there is a huge scope for somebody to do active investing and be able to beat the index by a fair bit of margin, what you call as alpha in technical language.
Yeah.
But in my opinion, thanks to the 2018 ruling of SEBI moving the PRI index to a TRI index and various other things, for active mutual funds on the large cap space to be able to beat the index has become a challenge, right, over the last 3 years. So a retail investor, in my opinion, who's looking at doing large cap kind of investing, I think passive investing is a brilliant way to invest. Keep doing SIPs in your ETFs, because look, theoretically you can't do an SIP in an ETF because it's a listed this. But like you rightly said, you probably have a nudge on the Fisdom app where you can do an SIP in the ETF. If you can do an SIP in the ETF, I don't see a reason, going just by historical data point, generating a 10 to 12% return compounding CAGR over the next 5-10 years should be any difficult. And please understand, at 12%, CAGR, you are almost doubling your money every 4.5, 5 years, right? So wealth creation, definitely, probably this is the simplest way to do. If you don't understand anything, just keep doing your SIPs in the index and you probably will be able to really be able to beat 90% of people who day trade or probably do a lot of this trading thing and are not really able to make money.
Yeah, I mean, I would like to add at this point that you mentioned. If we see historically from 78, 79, when we started the Sensex, and base being 100, today we are almost at 60,000. And if I go and calculate the CAGR, it's close to 16%. I mean, that's
About 16%, absolutely.
yeah. So that's amazing. And even if my ETF could probably give me about let's say about the 13.5 or 14%, reducing the cost of the errors that we get and tracking errors, and even the cost of purchasing, and so on, I think that's an amazing return to create wealth. So
In fact, I'll highlight something, Nainesh, why doing an ETF or index is more important or more interesting. is because index, a lot of us might not agree, but is more of a momentum play. You will always see how is index constructed without going into too much of technicality, right? Cutting all the crap down to one line. Whatever works in the market is included in the index, and what does not work is excluded in the index.
Absolutely.
So if you don't really have the ability to be able to switching your portfolio into what moves and what does not, index construction automatically does it. So if you buy the index, you automatically end up buying what is working, and it moves out of what it does not work. So I think it's a great play.
So the next question, obviously, one favorite one for all Indians. Okay, we're so emotionally attached to this asset class. We'll end up, in fact, putting a lot more percent than a actual portfolio should have. Let's talk about gold. Okay, so one is I want to first touch the macro bit. Why is gold resilient to market movements? Now, recently we've seen, normally when we see markets crashing, you see gold moving up. And we've always learned it, even in our textbooks, saying they have inverse correlation. However, in 2020, 2021, I actually noticed both of them moving together. I actually noticed that the entire concept that you should invest in gold to safeguard your equity investments has gone for a toss. Throw some light on how this happens and what you as an investor should do when it comes to gold as an asset class.
So Nainesh, if you kind of narrow down on this data point that we've always been fed saying it's inversely correlated to equity, you will understand that this inverse relationship is very short-lived. On the longer time frame, you will see that the relation is not negative but positive. So why is this negative correlation? Negative correlation is very, very simple. When you want to move out of risk asset, right, you want to find a safe haven. So let's say markets are tanking, right, and you are scared that what will happen to my equity investment, you remove that money. Now if you remove that money, theoretically you don't want to keep that lying in your bank account because it's making no returns for you. You are looking out for options where you can really go ahead and deploy this cash, right? Is where textbooks tell us that if you remove your money out of risk assets, right, and you are scared of the volatility in the market, you want to go ahead and park this somewhere. So there are two risk assets that globally everybody is accepted in our industry, which is probably a dollar and gold. So whenever you see markets tanking, people are afraid of volatility and so on and so forth, that money comes out of equity, moves to dollar and gold, and which is why in the short term you see dollar and gold moving up. But over a longer time frame, Nainesh, you will realize that gold and equity are not inversely correlated. They're positively correlated, and they move in the same direction, which is up over a period of time. But I'll tell you something that a lot of us typically miss out, and I'm writing a newsletter tomorrow on gold. So I will discuss about this slightly more on my LinkedIn and Twitter tomorrow. But I'll tell you something very interesting about gold. Gold, unfortunately, in theory, we are taught that gold, is an inflation hedge. So when inflation goes up, gold goes up.
Yeah.
But I can show you the last 10 years of data point. Gold has realistically done nothing when inflation has gone up. So what we really have to understand in terms of gold is gold typically does not move to inflation. Gold typically moves to real interest rates, right? Which is the rate that you make minus inflation. So let's say if the interest rate is 8% and inflation is 9, your real rate is -1.
Yeah.
So the more on the minus side you are on the real rate is the period where the gold typically outperforms, right? So it's not just a function of हाँ श्रीजा, तो ये सिर्फ फंक्शन इन्फ्लेशन का नहीं है, ये फंक्शन रियल इंटरेस्ट रेट्स का है. तो अगर आपका रियल इंटरेस्ट रेट पॉजिटिव है तो गोल्ड नहीं परफॉर्म करता. अगर आपका रियल इंटरेस्ट रेट नेगेटिव है तो गोल्ड परफॉर्म करता है. अब आप आज के कॉन्टेक्स्ट में देखिए, आप कह रहे हो इंटरेस्ट रेट्स ऊपर जाएगा, तो ये टिपिकली गोल्ड के लिए नेगेटिव होना चाहिए, राइट? पर फिर भी आप देख रहे हो गोल्ड स्टेबल है. गोल्ड क्यों स्टेबल है? गोल्ड इसलिए स्टेबल है मेरे हिसाब से क्योंकि मार्केट ये एंटिसिपेट कर रहा है कि इंटरेस्ट रेट्स ऊपर जाने पे इन्फ्लेशन इमीडिएटली नीचे नहीं आने वाला है. आप क्रूड देखिए $90 पे ट्रेड कर रहा है, जो इतने सालों में $90 तक नहीं आया था. Last, if I'm not wrong, I saw crude at these levels were 2008. I may be wrong with this data point, but
2008.
I've not seen crude at 90 for a long time. So yes, while interest rate going up is negative for gold, but market is not expecting that if interest rate goes up, inflation is going to come down. And hence, in my opinion, gold is so resilient today.
So yeah, I think that's a valid answer to why gold is not moving the way we've learned it in textbooks. However, what do you think? A question again on gold. What do you think is the best form of actually taking exposure to gold? Recently, we've heard a lot about the sovereign gold bonds issued by the RBI. How effective do you think these SGBs are? And what do you think an investor who wants to invest in gold and obviously not go for physical because of the cost involved, what's the next best place to go to get exposure in a portfolio?
Nainesh, in my opinion, you can either do a gold ETF or a sovereign gold bond. Both, in my opinion, are a good fit. I'll tell you what, in my opinion, are advantages and disadvantages. First, point number one: never go for digital gold. Digital gold, unfortunately, has a lot of spread, right? And okay, not going into too much of technicality. Let me rather focus on what you should ideally do, right? So look, what are the advantages of SGB? SGB pays you a 2.5% interest year on year, right? It is a sovereign product, so the probability of default you are assuming is close to zero. कि अगर गवर्नमेंट ने आपसे पैसा लिया तो गवर्नमेंट आपका पैसा वापस तो जरूर ही कर देगा, राइट? और अगर ये 2.5% के साथ आपको फ्यूचर में गोल्ड प्राइस ऊपर गया तो जितना भी ऊपर जाएगा उसका भी एडवांटेज मिल जाएगा. Now my only disconnect with SGB as a product is if you are not a trader or if you don't know how to sell this is कि मान लीजिए 8 साल बाद मैच्योरिटी पे, राइट, गोल्ड जब मैच्योर हो रहा है तब वो आपने लिया था उससे कम भाव पे मिल रहा है, तो आपको कंपलसरी वो कम भाव पे मैच्योरिटी का एडवांटेज ले लेना पड़ेगा. सो व्हाट कैन हैपन इज हर साल आपको 2.5% तो मिला पर कैपिटल गेन्स में कुछ नहीं मिलेगा, राइट? Is where I think ETF comes into picture for somebody who can slightly take more active investment calls. You know, it's much easier for you to move in, move out of gold ETFs. So for somebody who feels that, you know, I don't really have the bandwidth or understanding of timing gold prices or coming out of gold prices when gold has gone up and all of that, SGB is a much better way of investing. पर अगर आपको ऐसा लग रहा है कि you can do a better job in terms of timing gold prices really well. When I say timing, I am saying यार चलो आज $18,000 पे ट्रेड कर रहा है, 2200 चला जाएगा, अच्छा रिटर्न मिल गया, प्रॉफिट बुक कर लो. अगर आप वो कर सकते हो तो आपके लिए ETF है, बट इसके अलावा you should not look at any third option in my opinion.
Yeah, I think that's a valid point. And obviously, as Fisdom, we have a 2-click method of just buying a gold SGB. As simple as the journey is very, very simple for users. All you have to do is log on to the app, click SGBs, put your UPI ID, and you're good to go. And you can buy these products. Also, ETF the same way. So I think exposure to gold is taken care of. Before, obviously, I'll take some questions from the crowd before we go on to a very, very interesting part of our conversation. I had a question from one of our users, and he's asked, what do you think is the paint sector for budget? So, Kirtan, to you, paint sector for the budget.
Look, I'll be very honest, I have no idea about it, right? I'll tell you why. In my opinion, budget largely is a non-event in most cases, in my opinion, when you look at it from a longer time frame. Of course, if you are a trader, you might want to look at it from a different perspective. Like say, for example, PSU banks are running on an expectation that FII limits are going to be increased up to 74. You are expecting that there are going to be some soups in power sector because of this entire EV theme. We're also expecting that there is going to be a lot of EV related announcements that will happen. Look, all of these things are important in my opinion for a trader because she wants to make a call immediately on the day of budget or the next day. But if you really ask me, if you wait 1 week after the budget has gone by, you will have 100 data points that everybody around, people like you and me, will tell them कि budget में ये data point अच्छा था, ये sector के लिए ये sector अच्छा करेगा. So unless you are a trader, I think budget for most investors should be a non-event.
I agree. I mean, for short-term moves, obviously, budget is going to be a big thing because the volatility gives opportunities to traders. But for an investor, obviously, a horizon is bigger than just a upcoming budget. So for you, you should be tracking, the sector and then choosing your bets depending upon obviously how the sector can perform.
But like say, if I still have to answer this question of Aryan, not related to budget, but let's say probably sectors that look good maybe 3 years from today. So historically, if you've studied whenever interest rates have gone up, what kind of sectors have really performed under various situations. Look, we've got state elections coming up and all of these things, and there can be immediate blips in the market depending on which way it moves. But my understanding of studying the historical data points in a situation like we are today, from there on over the next 3-5 years, you've typically seen economy facing stocks really do well. You've seen banks do well, you've seen industrials do well, you've seen cement do well, autos do well, real estate do well, right? So it is not exactly the question that Aryan really wanted me to answer, but from a 3 or 5 year point of view, I think if you really have the appetite and can sit tight and absorb volatility, economy facing sectors, in my opinion, should do well.
So actually, I was going to get to that in the next round that I'm going to have with you, which is the rapid fire. However, I'll take one question before that. There's a question that a user is asking: is there any chance of GSEC yield increasing further?
Look, I'll tell you what the problem is. You will not be able to control GSEC yields moving forward, in my opinion. I'll give you a data point just yesterday. सिर्फ कल की बात कर रहा हूँ, ओके? कल जब आरबीआई 13,000 करोड़ रुपए के नए 10 ईयर बॉन्ड्स बेचने की कोशिश कर रहा था, राइट? 3,500 करोड़ के बिड्स उन्होंने एक्सेप्ट नहीं किए, जिसको मार्केट लैंग्वेज में डिवॉल्व बोलते हैं. तो आरबीआई आया बैंक्स के पास, बैंक्स को बोला 13,000 करोड़ के बॉन्ड्स मुझे आपको बेचने हैं. बैंक्स ने 13,000 करोड़ के लिए बिड तो किया, पर आरबीआई ने सिर्फ 9,500 करोड़ के बिड्स एक्सेप्ट किए, राइट? कितने पे? 6.78 पे, राइट? क्योंकि जो बाकी के 3,500 करोड़ के बिड्स थे वो 6.78 से काफी ऊपर थे. तो इसका ये एक सिंपल मतलब है कि बैंक्स आज आरबीआई को पैसा 6.78 से ज्यादा पे देना चाहता है. एंड अगर आप थोड़ा सा पिछला डेटा पॉइंट देखें पिछले 3-6 महीने से, ये रेगुलरली होते आ रहे हैं. अगर आप वेरिएबल रिवर्स रेपोज भी स्टडी करें, वेरिएबल रिवर्स रेपो 3.9% पे हो रहा है. सॉरी, मुझे नहीं पता आपको फिक्स्ड इनकम कितना समझते हैं और क्या ये टेक्निकल हो जाएगा या नहीं. आप देखिए क्रॉम्स और ट्रैप्स भी आज 3.6, 3.7 पे ट्रेड कर रहे हैं. तो मुझे नहीं लगता है जीसेक्स को कंट्रोल करना मुश्किल है. बट आई टेल यू समथिंग वेरी इंटरेस्टिंग, राइट? अगर आप हिस्टोरिकल डेटा पॉइंट स्टडी करें तो आपको पता चलेगा कि पिछले 10 सालों की बात कर ले, पिछले 10 सालों में यील्ड्स इंडिया में 10 ईयर के 6 और 9 के बीच में रहे, राइट? मुझे नहीं लगता यील्ड्स 9 तक जाएंगे, पर मुझे डेफिनेटली लगता है यील्ड 7.5-8 तक तो जाएंगे ही ओवर 2.5-3 ईयर पीरियड. आई रिजर्व द राइट टू बी कंप्लीटली रॉन्ग ऑन दिस, पर आज जो पिक्चर दिख रहा है उसके हिसाब से मुझे नहीं लगता है कि 7.5% का जीसेक पे यील्ड आ जाए तो मैं बिल्कुल भी सरप्राइज हो जाऊंगा. क्योंकि आज अगर आप देखेंगे तो बहुत सारे प्रॉब्लम्स हैं. गवर्नमेंट फिस्कल डेफिसिट में प्रॉब्लम है, पैसा नहीं है हमारे पास, करंट अकाउंट डेफिसिट इज मूविंग इन द रॉन्ग डायरेक्शन, ग्लोबली इंटरेस्ट रेट्स बढ़ रहे हैं. सो आई थिंक क्रूड का भाव बढ़ रहा है, इन्फ्लेशन बढ़ रहा है, ये सब यील्ड्स के लिए नेगेटिव है. तो मुझे नहीं लगता आई बी सरप्राइज अगर मैं जीसेक पे 7.5 देखूंगा 1 साल में. तो
thank you for that answer, Kirtan. That was actually a lot more in detail. And you explained it very well. Now let me go to the last part of our conversation, which is a rapid fire round. Okay, I'm going to ask you a few questions, and right away, whatever comes in your mind, you could throw it out to us. So, the first one, tell us one mistake that you've made in your investing career, which you want the users to know so that they don't make the same mistake.
So I was of a thought process that a company cannot go down to zero. So I saw in the earlier part of my career, I saw Satyam go down, Tech Mahindra take it over, and then whichever way. Keeping that in mind, I thought that the same would repeat in Kingfisher, and I made a huge loss in Kingfisher. So if you've seen a stock from 100 come down to 10, do not assume that the 10 cannot go down to 1.
So don't catch a falling knife. That's what you're saying.
Absolutely not.
Done. Tell me one rule, according to you, which investors should keep in mind while selecting stocks. The one most important rule.
Don't invest in things that you don't understand.
Tell me one rule that a trader should follow when
Follow
a
risk
trader
management.
is a risk management. I think that is the bang on answer. I was looking out for risk management. That's something that normally traders make their biggest mistake.
In fact, I've seen a lot of these traders not follow risk management, and which is why even when out of 4 calls they get 3 right, on one call that they go wrong, they're still in negative.
I agree. Tell me one sector that you would never bet on and the reason why.
I think airline. I think it is more to do with my experience in the past. But okay, jokes apart, if you look at the airline industry globally, not a lot of names that click to me that have been profitable and have been consistently making good ROEs. Probably.
Got it. And the last one sector that you'd surely bet on for the next 3 to 5 years.
Banks.
Got it. So as a closing remark, Kirtan, I would want you to kind of summarize this with a small advice that you would give all our clients who are first-time investors in the market on how they can build wealth.
Look, first, forget about what you've seen in the market over the last 18 to 24 months. That is not life. Markets don't move like that. Markets don't move linearly up. Market moves like this, right? So if you've only been experienced over the last 18, 24 months, do not extrapolate your experience over the last 18, 24 months, assuming markets work like that. They don't. You can lose some serious money and you will never come back to the equities market, blaming it on the market, whereas it's your fault. One. Second, don't invest in things that you don't understand, right? Do not get carried away by the FOMO of people discussing about various things and how they've made money in the markets, right? Stick to what you understand and you will really be able to do well, right? Third, very importantly, do not get carried away and start trading because you see a lot of these screenshots of people on the social media of how they made 10 lakhs, 1 crore, 10 crore in one day, right? I'm not saying that they would have not, but nobody on the social media comes and discusses the amount of money that they lost. They only talk about the good things that they've gone through. Four, very importantly, if you really want to make wealth, right, you need 2 things. You need longer time horizon and you have to be extremely disciplined, right? If you're going to get carried away by the volatility in the market, right, you will never be able to make wealth. To make wealth, be disciplined and be a long-term investor.
So on that note, Kirtan, thank you so much. And it was an amazing conversation. Even I learned a lot from what you explained, and I'm sure our users benefited. I'm looking forward to more conversations like this with you on maybe now specific topics where you could probably help us understand your fixed income or maybe mutual fund investments more in depth. So thank you for being a part of this show. I really enjoyed and looking forward to having you again.
Nainesh, thank you so much for having me on the show. I had an equally good time. Thank you so much.
Thanks a lot.